Be honest with me. How many times have you seen someone on social media shout, "Buy the dip," right after the market crashes? It feels exciting, right? Like you've been let in on a secret code word only the smart investors know. Stocks are down? Buy the dip. Crypto tanks? Buy the dip. Your cousin's friend's new altcoin goes from $5 to 50 cents? Definitely buy the dip. It sounds simple. Too simple. And that's the problem. I fell for it once. Actually, more than once. And it cost me real money. That's why I want to talk about why buy the dip is terrible advice for most people, and what you should actually be doing instead. Because here's the truth. Successful investing isn't about clever catchphrases. It's about building a system that doesn't fall apart the second the market takes a nosedive. My first buy the dip mistake. Let me take you back to 2018. Bitcoin had just crashed hard, and everyone around me was buzzing. This is the moment! Buy the dip! I didn't want to miss out. So I took $2,000, money I probably should have been saving, and jumped in. Guess what happened? The dip dipped lower. My $2,000 turned into $1,200 almost overnight. I panicked, sold, and swore off investing for months. Here's the kicker. If I had just kept that money in for a few years, I would have been fine. But the buy the dip hype made me think I was making a genius move, when really, I was gambling without a plan. That's the first problem with buy the dip. It sounds like strategy. But for most people, it's just an emotional reaction dressed up as wisdom. Why buy the dip doesn't work the way you think. There are 3 big reasons this advice is dangerous. 1. You never know how low the dip will go. Let's say a stock falls from $100 to $80. Is that the dip? Or will it slide to $60 or $40? Unless you've secretly invented a time machine, you don't know. What usually happens is people buy too early, watch their investment shrink further, and then panic. 2. It encourages gambling, not investing. Buying dips turns investing into a game of timing. And here's the truth. Even professionals get timing wrong. If full-time traders with advanced tools can't consistently predict dips, why would the rest of us? 3. It feeds fear and FOMO. Most people don't calmly buy dips as part of a disciplined plan. They buy out of fear of missing out. That's what happened to me with Bitcoin. It wasn't about a strategy. It was about not wanting to be the only one left out. What the wealthy actually do. So if buy the dip is terrible advice, what should you do instead? The answer isn't flashy. It won't make for a viral tweet. But it's how real wealth gets built. Systematic investing. Wealthy long-term investors don't chase dips. They don't panic when markets drop. They have a plan, and they stick to it whether the market is soaring or crashing. Let me give you an example. Meet Laura, the anti-dip investor. Laura is a teacher I met through a money workshop. Back in 2008, during the financial crisis, she watched her retirement account lose nearly half its value. Everyone around her was freaking out. Coworkers were cashing out. Friends were saying it was the end of the economy. Laura didn't sell, she didn't panic, and she didn't rush to buy the dip. Instead, she just kept doing what she always did, investing a little out of every paycheck into her retirement account. Fast forward to today, and that same account has grown several times over. Her secret wasn't timing. It wasn't clever. It was boring consistency. But boring consistency turned into financial security. That's the mindset you want. The better alternative. Dollar cost averaging. Here's the strategy that actually works for regular people. Dollar cost averaging. DCA. Fancy phrase, simple concept. Instead of waiting for dips, you invest a fixed amount on a fixed schedule. Maybe it's $200 every month. Maybe it's $50 every week. You don't care if the market is up or down. You just keep buying. What happens over time is magical. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over the long run, you average into a good price without trying to outsmart the market. That's how you win. Not by buying the dip, but by buying no matter what. My personal system. Let me show you exactly how I do it. Step 1. Automate. On payday, a percentage of my income automatically moves into my investment account. I don't touch it. I don't time it. It just happens. Step 2. Keep it simple. I stick to broad index funds like the S&P 500. No hot stock tips, no chasing trends, just steady, diversified growth. Step 3. Stay the course. Whether the market is crashing or hitting record highs, I stay consistent. That's the hardest part, but also the most important. The key here is that I don't wait for dips. I don't even check the market daily. My system invests for me whether I feel scared or excited. The psychology of it. Let's talk about the mental side for a second, because this is where most people struggle. Buy the dip plays on our emotions. We get excited when things are cheap, terrified when they fall lower, and greedy when they rise. It's a roller coaster. Dollar cost averaging, on the other hand, removes emotion. It's boring, it's steady. And that's exactly why it works. Think about it. When was the last time being emotional with money made you a better decision? Never. What if you already bought the dip? Maybe you're reading this thinking, uh-oh, I already bought the dip. That's okay. We've all done it. I've done it more times than I care to admit. The key is not to beat yourself up. It's to adjust going forward. Here's what you can do. 1. Don't panic sell. If you bought quality investments, broad funds, not random penny stocks, holding long-term can still pay off. 2. Build your system. Start dollar cost averaging from here. 3. Shift your focus from timing to consistency. The big picture. Let me tell you another quick story. During the COVID crash of 2020, the market fell over 30% in a matter of weeks. People were screaming, "Buy the dip," and many did. Some made money, others lost when they bought too soon. Meanwhile, people who were simply dollar cost averaging, the ones who had systems in place, didn't stress. Their automatic contributions kept buying shares at lower prices. And when the market recovered, they came out ahead. That's the power of a system. Why boring beats? Exciting. I get it. Buy the dip feels exciting. It feels like action. It feels like you're seizing an opportunity. Dollar cost averaging feels boring. But here's the reality. Boring works. Wealth isn't built on excitement. It's built on habits, patience, and time. It's built by sticking to a plan when everyone else is chasing the next shiny object. Final thoughts. So, let's wrap this up. Buy the dip might sound smart, but for most people, it's terrible advice. You can't predict dips. You can't time markets. And chasing them just turns investing into gambling. The smarter move? Build a system. Automate it. Stick to dollar cost averaging. Focus on consistency, not cleverness. Because at the end of the day, wealth isn't about catching the perfect dip. It's about showing up, again and again, with discipline. Imagine yourself 5, 10, 20 years from now. You're looking at an account that's grown steadily, stress-free, because you stopped chasing dips and started building habits. That's what's waiting for you if you start today. So here's my challenge. Instead of waiting for the next dip, set up your system. Automate your investments. Take emotion out of it. Do this instead, and watch how much calmer and wealthier your future feels. And if you found this helpful and you want more real, no BS conversations about money that actually make sense, go ahead and subscribe. Let's grow smarter, steadier, and richer together.